All right, so I always hear investors talking about cash flow and how they only want to invest if the property is cash flow positive, thinking that if they have enough cash flow positive real estate, that will allow them to retire from their job and they can sit on a beach and do nothing for the rest of their life. And it is a good dream, and believe me, I had the same dream at one point as well. And in this video, I'm going to explain why cash flow in residential real estate doesn't really exist and why you may want to change your approach. So, stay tuned. I'm That Agent Kelly. I talk about Canadian real estate in my local market of Abbotsford in the Fraser Valley. If you get any value from my content, subscribe to the channel and please do like this video. And if you'd like to chat about buying or selling real estate, you can scroll down into my description, click on that link and book yourself right in my calendar at a time that's convenient for you. All right, so I used to think like this myself. If I had bought enough cash flow real estate, then eventually the cash flow that I'm getting from the real estate would replace my job as a plumber, and I would eventually be able to quit my job as a plumber and go do something else and, just kind of chill and live off the cash flow. And there is a way you can do this. It's called the BRRRR strategy, the BRRRR strategy. Basically, you buy a property far under market value with a private loan, somebody else's money. You rehab the property, you renovate the property, you force some appreciation, you refinance all of your capital out. After the refinance, the property is still cash flow positive, you rent it out, and then you repeat. Problem with that is you have to be in a market that's not competitive enough where you can actually get these deals far enough under market value. And the property still has to be cash flow positive after the refinance, which is super, super difficult to do. Very few markets are like this where both of these things are true, where you can get the cash flow real estate and it's not competitive enough where you can get the deal. And not only that, the BRRRR strategy is a full-time active investing strategy. It's a lot less passive. It's a full-time job actually having to go out and find these deals. You're door knocking, you're sending out mailers, you're doing whatever it takes, you're cold calling to try and actually find the deals where people want to sell their homes underneath market value. Now, for most property that you can invest passively into, especially here in Canada, the value of the property is going to be, $500,000. You're putting down $100K, and then it's going to cash flow, maybe $300 a month, maybe $500 if you're lucky. Meaning you're going to have to own 10 of these properties before you're actually making enough money to quit your day job, and that is going to take a long time. Saving up $100K deposit or $100K down payment 10 times is going to take a lot of time. And I'll tell you guys something, I really wanted to do this. This was my dream for a long time, just own a bunch of real estate that brought in passive income so I quit my job as a plumber, go do whatever I wanted. So I bought a $150,000 detached home in Windsor, Ontario that cash flowed $300 a month at the time. Today it's worth like $350. And now a cash flow is like $700 a month. And you might think, that's amazing. You have a property that you paid $150 for, it cash flows $700 a month. However, today that property's worth $350. If I were to buy it now, it'd probably be cash flow neutral. And I'd need 70 grand down to buy the cash flow neutral property. Not only that, I've owned this property for nearly 4 years, and all the cash flow that I've accumulated up until this point is about $18,000, and it's set aside in the bank account that I have just for that property. And if one repair comes up, furnace, perimeter drainage, roof, maybe the tenant moves out, I have to redo the flooring and paint the house again, boom, all that cash flow is gone. 4 years of cash flow evaporated just like that. So cash flow in residential real estate doesn't really exist because eventually, somewhere down the line, unless you sell it beforehand, a repair will come up that will eat away or deplete pretty much all of the cash flow that you've made up until that point. Now, in commercial real estate, cash flow exists because the way the leases are structured is that the tenant pays for property tax, insurance, strata fees, repairs. They pay for anything. So any cash flow that you have on top of the expenses you have to pay goes right into your pocket, and there's really not much that you need to worry about. In residential real estate, it doesn't work like that because the tenants do not pay for the repairs. You pay for the repairs. So going forward, I will be investing in appreciating markets only. Now, the Windsor property has appreciated a ton, but I got in at a really good time, and obviously today, real estate there doesn't cash flow like it did back then. But not only that, that market had stayed flat for about 12 years before I bought there. So I just got in at a really lucky time. I did my research. I found that there are a lot of big things coming to that market. They were building a bridge from Windsor to Detroit that was going to employ 1,000 people making 80 grand a year. They were renovating the mall, $37 million renovation. They were expanding their university campus there, which brings in tech students. They were doing a bunch of stuff that was going to, accelerate economic growth in the area. So I thought, my mortgage is $500. It's a car payment. What can I lose? Luckily, the market went up a lot right after I bought there. But anyways, the ideology I'm going to be following going forward is exactly the same to the ideology that people follow in the stock market. And basically what that is they say when you're young, your portfolio should be largely allocated towards growth stocks to grow your net worth as fast as possible. And then when you're getting older, kind of moving towards retirement, you kind of structure your portfolio more towards dividends, and then you live off the dividend income, which is exactly like cash flow real estate. And if you apply this to real estate, you can structure your portfolio towards appreciating markets like Toronto and Vancouver or wherever else, San Francisco. And then once you get older, take up the net worth that you've built in those appreciating markets and allocate it into multifamily or commercial real estate. Cash flow is a defensive metric used to protect the health of your investment, so you can continue holding that investment through downturns in the market, or if any big repairs come up, you've got the reserves to cover them. You set that cash flow aside in a bank account every month, you do not touch it, and you just hold it there as reserves, so if anything comes up, vacancies, repairs, whatever it may be, you've got the cash there ready to service those repairs and those expenses that come up. So it's not really meant to make you money, it's meant to protect you. Now, if you're investing in an appreciating market, you're probably not going to have cash flow, so something you can do to protect yourself, and I'll just give you an example. You buy a $500,000 property, you put 100 grand down to buy that, and maybe you're losing 300 bucks a month. Actually, let's just say 250 to keep it easy, because I think that's a relatively realistic amount to be losing in an appreciating market. So 250 bucks a month, that's $3,000 a year. When you buy that property, set aside an additional $15,000 into a bank account as a reserve. So instead of the cash flow building that reserve, you've already built it. Now, most people might take that 15 grand and put it towards the mortgage to help bring down their payment. Like you'll hear a lot of people putting down 30, 40% in these appreciating markets. You can do that if you'd like to, but that $15,000 is realistically only going to drop your monthly payment maybe 75 bucks a month right now. So instead, put it in that bank account. And if you're losing 3 grand a year, well, it's going to take 5 years to eat through that cash flow reserve, or I guess that reserve that you've built yourself, maybe 4 years if some repairs come up. But the ideology here is typically in appreciating markets, after 3 to 5 years have passed, rents are higher, maybe you can refinance your mortgage into a better rate, or after the 5-year mortgage term, you can actually roll your mortgage out another 30 years to drop your payment. You'll have some options to actually get into a cash flow positive position after you've been holding that property for 3 to 5 years. And this is typically what has happened in appreciating markets because the rent does pretty well always goes up. As an example, I bought my condo in Abbotsford and it would rent for about $1,050 5 years ago. Today it rents for nearly double at 2,000 bucks a month. When I bought it, it probably would have been cash flow negative 400 bucks a month. Today I'd probably cash flow 300 bucks a month. So anyways, I hope this helps shed some insight onto cash flow positive property out there for some of you people looking to only invest in cash flow positive real estate. To be honest with you guys, it doesn't really exist in residential real estate, and in my opinion, I'd rather just invest in an appreciating market, grow my net worth faster, and then eventually move my portfolio into real estate that is truly cash flow positive. I know there's a lot of podcasts out there with US investors that, live and die by cash flow real estate, and, the dream out there is real because you can buy properties below market value after the refinance that cash flow positively. There's much more tax advantages when you sell that real estate with a 1031 exchange. We don't have anything like that here in Canada. So my opinion is that, and what I'll be doing going forward is I'll be investing in appreciating markets only, and then possibly even selling all my real estate when I get older and moving it into dividend stocks or possibly commercial or multifamily real estate. So anyways, if you enjoyed this video, thumbs up, subscribe. If you want to book a call, you can do that. Scroll down, click on that link, and yeah, thanks for watching. We'll see you on the next one.